On April 8, 2026, the Dow Jones recorded its strongest single-day performance in a year, surging 1,325 points as investors reacted to a sudden shift in the Middle East. This rally was mirrored by a collapse in energy prices. WTI crude, the U.S. benchmark, plummeted over 16%, the largest single-day decline for oil since the pandemic shocks of April 2020. This buying frenzy quickly spread across the globe. South Korea's Kospi led gains in Asia, while European markets like the Paris Bourse saw record-breaking sessions, with Germany's DAX posting its best performance since March 2022. The catalyst for this sudden optimism was an 11th-hour ceasefire agreement reached between the United States and Iran. The timing was razor-thin. The deal was announced barely an hour before a self-imposed U.S. deadline to launch wide-scale military strikes against Iranian targets. Beyond the headlines, the deal had an immediate physical impact. It allowed for the reopening of the Strait of Hormuz, which had been effectively closed to commercial traffic for over 5 weeks. While equity markets moved to price in a return to stability, the sheer speed of the rally suggests a market reacting to immediate relief rather than long-term resolution. Despite the soaring stock indices, a look at institutional positioning reveals a significant contradiction in how the smart money is viewing this truce. Wall Street's fear gauge, the VIX, dropped 22. Large-scale investors are treating the ceasefire as a temporary pause, keeping their defenses high in case the diplomatic opening proves to be short-lived. The roots of this volatility trace back to late February, when a series of U.S. and Israeli military strikes targeted Iranian infrastructure. Tehran responded by leveraging its most powerful economic weapon, the closure of the Strait of Hormuz to commercial shipping. This map illustrates the gravity of that decision. The strait handles roughly 20. Pakistan, represented here by the Faisal Mosque, played a central role in the diplomatic push that finally secured the current ceasefire. However, the actual agreement contains a major caveat. Iran has only guaranteed a 2-week window for commercial transit to resume. Furthermore, all shipping companies must coordinate their movements directly with the Iranian armed forces, keeping the risk of a sudden seizure or stoppage extremely high. This graph of WTI crude prices reveals the reality. Prices dropped to $94.41, but remain far above the $67 pre-conflict baseline. This shaded red gap is the lingering war premium. Oil is still 47% more expensive, meaning underlying economic pressure remains. This sustained high price continues to drive up the cost of agricultural commodities and fertilizers, as natural gas disruptions remain a factor in global production chains. For emerging market economies and energy importers, the oil shock continues to drain foreign reserves and drive inflation, even with the guns currently silent. Geopolitical analysts warn that a massive trust deficit remains between Washington and Tehran, casting doubt on the long-term viability of the truce. Critical issues, including Iran's nuclear program and the presence of U.S. forces in the region, were left unaddressed in the scramble to stop the immediate fighting. The U.S. administration's primary motivation was to find an off-ramp that would help contain domestic energy prices and ease the burden on consumers. This creates a timeline driven by the upcoming U.S. midterm elections, where keeping gas prices stable is a top political priority for the White House. This timeline illustrates the converging risks. Once the midterms pass and the political pressure to maintain low energy prices eases, the threshold for returning to military action becomes significantly lower. This surge in the stock market reflects a desperate need for breathing room. The ultimate question is whether this 2-week window allows for a diplomatic breakthrough or simply delays an inevitable return to the blockade.